If you've ever asked, should I be in stocks or bonds? This is the only video you need to watch. By the end, you'll know exactly what each one is, when to use it, and how to mix them. $10,000 invested 40 years ago in the S&P 500. Today it's worth around $450,000. The same $10,000 in long-term US Treasury bonds. About $70,000. That gap, over 6 times more money, is what this video is about, and more importantly, what to do about it. Quick recap if you've watched our other videos. A stock is a tiny ownership piece of a public company. When you buy Apple stock, you literally own a fraction of Apple, about 1/10 billionth of it. You profit when the company grows, through both rising share price and dividends. Stocks have historically returned around 10% per year on average, but they swing wildly in the short term. They are best for long-term goals, ideally 10 years or more. We did a full video on the S&P 500. That's episode 3 of this series. Bonds are different. When you buy a bond, you're not buying ownership, you're loaning money. Specifically, you're loaning money to a government, a city, or a company. In return, they promise to pay you interest at a fixed rate, then return your original investment when the bond matures. The most common type, US Treasury bonds, are loans to the federal government, considered some of the safest investments in the world. Bonds typically return around 4 to 6% a year, with much smaller swings than stocks. They are best for short to medium-term goals or for people approaching retirement. Here's how they actually stack up side by side. On returns, stocks have historically returned about double what bonds do over long periods. Stocks win on growth. On volatility, bonds win by a lot. Stocks can drop 50% in a bad year. Bonds usually move just a few percent. On time horizon, stocks need at least 10 years to smooth out their volatility. Bonds work for shorter goals, 1 to 5 years. On income, stocks pay dividends, which are sometimes taxed at lower rates. Bonds pay interest, which is usually taxed as ordinary income. The verdict, they do different jobs. Most portfolios need both. Here's that gap visualized. $10,000 in stocks, $10,000 in bonds. Same starting point, same 40 years. Watch what happens. After 10 years, stocks have basically doubled to 26,000. Bonds are at 16,000, pulling away, but still close. After 20 years, stocks are at 67,000, bonds at 27. The gap is widening fast. By year 40, stocks at 453,000, bonds at 70,000. That's 6 times more money from the exact same starting point. Compound returns are merciless. The higher rate compounds harder over time. So which one do you actually use? Match the asset to when you'll need the money. Money you need within a year, keep it in cash or a high-yield savings account. Stocks are too volatile for short windows. Money you need in 1 to 5 years. Short-term bonds or certificates of deposit. Money you need in 5 to 15 years. A balanced mix, often around 60% stocks and 40% bonds. And money you don't need for 15 years or more, like retirement when you're young, heavy stocks, often 80 to 100%. The longer your horizon, the more stocks make sense, because their volatility smooths out over time. How much of each should you actually own? 2 simple rules to start. The classic balanced portfolio is 60% stocks, 40% bonds. It's been the default for decades and works well for most middle-aged investors. The age-based rule is even simpler. Take 110, subtract your age, and that's your stock percentage. Age 30, 80% stocks. Age 50, 60% stocks. Age 70, 40% stocks. As you get older and have less time to recover from a crash, you shift toward bonds. These are starting points, not laws, but they keep most beginners out of trouble. 3 myths to bust before you go. Myth 1. Bonds are completely safe. False. Bonds carry interest rate risk. When interest rates rise, the value of existing bonds drops. In 2022, US bonds had their worst year in modern history, losing around 13%. Safe doesn't mean immune. Myth 2. Stocks are too risky for me. Over short windows, yes, stocks are risky. But over 20-year periods, the S&P 500 has never lost money. The risk you feel is short-term, The opportunity is long-term. Myth 3. There's one right allocation for everyone. There isn't. The right mix depends on your goals, your timeline, and how you actually feel when markets crash. The best allocation is the one you can actually stick with. Stocks for growth, bonds for stability. Most portfolios need both. The right mix depends on when you'll need the money. Match your assets to your timeline, then let time do the rest.